This is the story of the Queen of the Internet. The story of Mary Meeker. September 1959. A baby girl was born in Portland, Indiana, a small farming town of just 6,000 people. Her parents named her Mary after her mother. This wasn't Silicon Valley or Wall Street. It was the American heartland where basketball mattered more than technology, where ambition meant steady work, not billion-dollar startups. Mary's father Gordon was a golf enthusiast. Intense, competitive, driven. He passed these traits to his daughter. From an early age, Mary learned what it meant to compete, to push herself, to never settle for good enough when great was possible. She became captain of her high school golf team. Not for the trophy, but because she wanted to win. That competitive fire would define her entire career. Growing up in a small town taught Mary something important. Size doesn't determine success. She watched small towns beat big ones on the basketball court. She saw how one determined person could make a difference. Later she would tell journalists this Midwestern upbringing shaped how she looked at entrepreneurs. She didn't need them from Stanford with perfect pedigrees. She needed them to have fire, obsession, willingness to outwork everyone else. But Portland, Indiana in the 1960s was worlds away from Silicon Valley. When Mary grew up, the internet didn't exist. Personal computers weren't even a fantasy. The technology revolution that would define her life hadn't begun. She had no way of knowing she would become the person who helped shape that revolution. Who would identify trends before anyone else saw them coming? Who would invest billions into companies changing how the world works? Mary graduated from DePaul University in 1981 with a psychology degree. Not business. Not finance. Not computer science. Psychology. She wanted to understand how people think. What motivates them? Why they make certain decisions. This became one of her secret advantages. While other investors focused purely on numbers and technology, Mary understood human behavior. She could see why consumers would adopt a new product. Why a founder had passion to build something great. Why some businesses would succeed and others fail. After DePaul, Mary went to Cornell University for her MBA in finance. This was 1986. The personal computer revolution was just beginning. Microsoft had gone public earlier that year. Apple was still young, fighting for survival. The internet as we know it wouldn't exist for another decade. But something was stirring. Technology was starting to change from being just for scientists and hobbyists to something that might reach ordinary people. Mary started her career in 1982 at Merrill Lynch as a stockbroker. This was Wall Street at its most traditional. Men in suits. Trading floors. Paper stock certificates. She was learning the fundamentals of finance. Of markets. Of how capital moves through the economy. But she wasn't satisfied just following established players. She wanted to find what was coming next. After finishing her MBA in 1986, Mary moved to Salomon Brothers as an analyst covering technology. This was her first taste of tech investing. She began following companies like Microsoft and Adobe. Companies building software that would run on personal computers. She developed a reputation for deep research. For understanding not just whether a company was making money now, but whether it would continue growing for years to come. In 1990, Mary moved to Cowen briefly. Then in 1991 she landed at Morgan Stanley. This move would define the next 20 years of her life. Morgan Stanley gave her the platform to become one of the most influential technology analysts on Wall Street. She was tasked with covering personal computers and consumer software industries. These weren't the hottest sectors at the time. Tech was interesting but not the phenomenon it would become. Mary would help change that. The early 1990s were fascinating in technology. Personal computers had moved from enthusiast products to something found in businesses and homes. Microsoft Windows was spreading. Software companies were proliferating. But the real revolution was just beginning. In 1993, the Mosaic web browser launched. It made the internet accessible to normal people for the first time. Mark Andreessen and his team at the University of Illinois had created something that would change everything. By 1995, Andreessen had left academia and founded Netscape Communications. They built a commercial web browser better and faster than anything else available. Suddenly, the internet wasn't just for researchers and academics. It was for everyone. Netscape wanted to go public. They chose Morgan Stanley to lead the offering. Mary Meeker was assigned to the deal. August 9, 1995. Netscape went public. The initial offering price was $28 per share. By end of first day trading, the stock had soared to $75. The company was suddenly worth nearly $3 billion. This wasn't just another IPO. This was the moment that announced to the world the internet was here. That it mattered. That investing in internet companies could create enormous wealth. Mary had been studying the internet intensely. She saw something most people on Wall Street didn't understand yet. This wasn't just about one company or one browser. This was about a fundamental transformation in how people communicate, find information, do business, live their lives. The internet was going to be bigger than television, bigger than radio, maybe as transformative as the printing press or telephone. In February 1996, Mary and her colleague Chris DePue published the Internet Report. This wasn't a typical Wall Street research note. It was a 322-page deep dive into what the internet was, how it worked, who was using it, where it was going. The report analyzed everything from access providers to networking equipment to content companies. It provided financial models, growth projections, investment theses for dozens of companies. The Internet Report became known as the Bible for tech investors. It was passed around venture capital firms in Silicon Valley, read by entrepreneurs trying to understand their market, studied by executives at established companies trying to figure out if the internet was threat or opportunity. Mary had done something remarkable. She had taken a complex, rapidly evolving technology and made it comprehensible. She had shown people how to think about the internet as an investment opportunity. The report was so influential, Harper Business published it as a book. It sold widely. Mark Andreessen, co-founder of Netscape, said the report offered critical insight into both the internet and the markets it would affect. Steve Case, chairman of America Online, called it a fabulous history, encyclopedia, reference guide, and roadmap rolled together. Benjamin Rosen, chairman of Compaq Computer, said whether you're an internet investor, user, or supplier, this is the one source you'd be foolish to be without. Mary had established herself as the preeminent internet analyst on Wall Street. Barron's magazine crowned her Queen of the Net in 1998. The nickname stuck. For the next 2 decades, Mary Meeker would be known as the Queen of the Internet. But she wasn't done. The dot-com boom was just beginning. Mary was positioned at the center of it. From 1996 to 2000, the internet stock market went into overdrive. Every week brought new IPOs. Companies with no profits and sometimes no revenue were valued in the billions. Investors poured money into anything with .com in its name. Mary was advising on many of these deals. She championed companies like Amazon, which had gone public in 1997. She backed eBay, which had its IPO in 1998. She supported Yahoo, which had become one of the most valuable companies in the world. Mary's bullish reports on these companies helped drive investor enthusiasm. When she said a company was going to be big, people listened. Her recommendations moved markets. She had built a reputation for spotting winners early. Dell, Microsoft, Intuit, Netscape, AOL, Amazon, Yahoo, eBay. These were companies she had championed when they were younger, less proven, more risky. Now they were printing money and making their early investors rich. But Mary also made mistakes. In 2000, she was enthusiastic about AOL's acquisition of Time Warner. This deal would become one of the biggest disasters in corporate history. AOL's internet business model was already becoming obsolete. The merger destroyed enormous amounts of shareholder value. Mary also backed Excite at Home, a company that combined internet access with content. It went bankrupt in 2001. She recommended drugstore.com, which never figured out how to compete with traditional pharmacies and eventually failed. These failures mattered because of what came next. In March 2000, the dot-com bubble burst. The Nasdaq, which had hit a peak above 5,000, began a brutal decline that would eventually take it below 1,200. Trillions of dollars in market value evaporated. Companies that had been valued in the billions went bankrupt. The internet revolution, which had seemed unstoppable, suddenly looked like it might have been a mirage. Mary and other star Wall Street analysts came under intense scrutiny. Investigations began into whether analysts had been too optimistic about companies, whether they had recommended stocks to please investment banking clients rather than because the stocks were actually good investments, whether they had misled ordinary investors who trusted their advice. The investigations were brutal. The press vilified Mary and her peers. She was accused of being part of a corrupt system that had pumped up internet stocks to profit Morgan Stanley's investment banking business while ordinary investors lost their savings. The New York Attorney General launched a major probe. Regulators demanded answers. The reputation Mary had built over a decade was suddenly under attack. In April 2003, Morgan Stanley and 9 other investment firms agreed to a massive legal settlement. They paid $1.4 billion in fines and agreed to reforms in how they handled research and investment banking. Mary Meeker personally was not charged with any wrongdoing. The investigations found no evidence she had acted illegally or unethically. But the damage to her reputation had been done. For many analysts, this would have been the end. The scrutiny, the criticism, the destroyed reputations. Many of Mary's peers left Wall Street. Some retired. Some moved to hedge funds. Some just disappeared from public view. But Mary did something different. She went back to work. She continued publishing research. She continued analyzing tech companies. She continued making predictions about where the internet was going. In 2006, Fortune magazine published a major profile of Mary's comeback. Writer Andrew Sower described her as absolutely first-rate when it comes to spotting big-picture trends before they come into focus. He noted she gathers massive amounts of data and assembles it into voluminous reports that, while sometimes rambling and overambitious, are stuffed with a million jumping-off points. The message was clear. Mary Meeker was back. Part of Mary's recovery came from being right about what happened after the bubble burst. Yes, many internet companies had failed. Yes, valuations had been absurd. But the internet itself hadn't gone away. In fact, it had continued growing. More people were getting online. Broadband was replacing dial-up. New companies were emerging that had real business models and were generating real profits. Google had launched and was becoming dominant in search. Amazon had survived and was transforming retail. eBay was a juggernaut in online auctions. Mary published new landmark reports on emerging internet trends. She covered online advertising and how it was starting to surpass traditional media. She analyzed e-commerce and the evolution of search engines. She wrote extensively about the internet in China, where hundreds of millions of new users were coming online and creating an entirely new internet economy. She documented the rise of mobile internet, predicting smartphones would become the primary way people accessed the web. In August 2000, Google went public. Morgan Stanley, with Mary as research analyst, served as lead manager for the IPO. This was vindication. Google was the real deal. It had a brilliant business model. It was printing cash. Its advertising platform was revolutionizing how businesses reached customers. The IPO was a massive success. Google's stock would go on to multiply many times over. By 2010, Mary had been at Morgan Stanley for nearly 20 years. She had survived the dot-com crash. She had rebuilt her reputation. She was once again seen as one of the smartest people in tech. But she was starting to feel restless. Wall Street was about public companies, about research reports, about making recommendations to investors. Mary wanted something different. She wanted to work directly with entrepreneurs. She wanted to help build companies rather than just analyze them. In December 2010, Mary made a surprising move. She left her position as managing director at Morgan Stanley and head of the bank's global technology research team. She was joining Kleiner, Perkins, Caulfield & Byers, one of the most prestigious venture capital firms in Silicon Valley. This wasn't just a job change. This was Mary Meeker reinventing herself. At age 51, she was leaving the comfortable world of Wall Street research to become a venture capitalist. Kleiner Perkins was legendary. Founded in 1972, the firm had backed some of the most important technology companies in history. They had invested in AOL, Amazon, Compaq, Electronic Arts, Google, Intuit, Netscape, and many others. Their partners were famous. John Doerr, who had backed Google and Amazon, was considered one of the greatest venture capitalists ever. Kleiner Perkins had the reputation, the network, and the capital to make big bets on transformative companies. Mary was brought in to lead the firm's digital growth fund. This was different from traditional venture capital. Most VC firms invest in very early-stage startups, putting in a few $1 million when a company is just getting started. Growth investing is different. It focuses on companies that are past the startup phase but haven't yet gone public. These are companies doing tens or hundreds of millions in revenue, but they need capital to scale even bigger. They need strategic help to navigate complex decisions about entering new markets, hiring executives, preparing for an IPO. Mary's experience made her perfect for this role. She had deep knowledge of technology trends. She had spent decades evaluating public technology companies and understanding what made them successful. She had relationships with the most important executives in tech. She knew how to analyze a business model, how to evaluate competitive dynamics, how to think about valuation. She could help growth-stage companies prepare for life as public companies. At Kleiner Perkins, Mary moved fast. She led investments in Facebook when it was still growing rapidly. She backed Square, the payments company founded by Jack Dorsey, which was revolutionizing how small businesses accepted credit cards. She invested in Spotify, the music streaming service transforming the music industry. She bet on Twitter, the social network becoming essential for real-time news and communication. Mary also backed companies like LegalZoom, which was making legal services accessible online. She invested in DocuSign, which was digitizing business contracts and signatures. She put money into Lending Club, a peer-to-peer lending platform. She backed JD.com, one of China's largest e-commerce companies. She invested in Waze, the crowdsourced navigation app that would eventually be acquired by Google. She supported Slack, the workplace communication tool that would become one of the fastest-growing enterprise software companies ever. Then there were the even bigger bets. Mary invested in Airbnb when it was still fighting to convince cities and regulators that short-term rentals should be legal. She backed Instacart as it was building infrastructure for grocery delivery. She invested in Who's, the platform for home remodeling and design. She put money into Nextdoor, the neighborhood social network. She backed Pinterest, the visual discovery platform. Not every investment worked. Some companies struggled. Some never found product-market fit. Some faced regulatory challenges they couldn't overcome. But Mary's hit rate was extraordinary. Many of her investments became billion-dollar companies. Some became tens of billions. Her portfolio companies were changing industries. They were creating new markets. They were generating thousands of jobs. Mary brought something else to Kleiner Perkins beyond just capital. She brought her analytical framework. She continued publishing her Internet Trends report, but now as a venture capitalist rather than a Wall Street analyst. Every year she would give a presentation at major tech conferences, walking through hundreds of slides of data about internet usage, mobile adoption, e-commerce growth, advertising trends, and technology adoption around the world. These presentations became legendary. Tech executives would clear their calendars to attend. Investors would study every slide. Journalists would write dozens of articles analyzing her findings. Mary had a gift for taking enormous amounts of data and synthesizing it into clear insights. She could show how different trends were connected. She could identify where growth was accelerating and where it was slowing. She could spot new patterns before others saw them. In her 2015 Internet Trends report, Mary noted that mobile internet usage had finally surpassed desktop. This was a massive shift. It meant every company needed to think mobile first. It meant apps were more important than websites. It meant the internet was becoming truly ubiquitous, available anywhere, anytime. Companies that didn't adapt would be left behind. In her 2016 report, Mary highlighted the rise of on-demand services. Companies like Uber, Lyft, DoorDash, and Instacart were growing explosively. They were using mobile technology to connect supply and demand in real time. They were creating entirely new markets. Mary showed how this trend was just beginning. How it would expand to more and more categories of goods and services. In her 2017 report, Mary focused on voice computing. Amazon's Alexa, Apple's Siri, and Google Assistant were gaining rapid adoption. People were starting to interact with technology through speech rather than typing. This would create new opportunities and challenges. Companies needed to think about voice interfaces, about how their services would work when accessed through a smart speaker. But while Mary was thriving at Kleiner Perkins, tensions were building inside the firm. Kleiner had historically been an early-stage venture capital firm. They invested in startups when they were just a few people with an idea. But Mary's growth fund was different. It invested much larger amounts in more mature companies. The early-stage partners and growth-stage partners had different investment philosophies, different time horizons, different ways of working. In 2017, Kleiner Perkins hired Mamoon Hamid from Social Capital to strengthen their early-stage practice. Hamid was talented and ambitious. He wanted to increase the size of early-stage investments. But this started to overlap with what Mary's team was doing. There were conflicts about which team should lead certain deals. There were disagreements about strategy and focus. By 2018, it was clear the two parts of Kleiner Perkins needed to separate. Mary and her growth team decided to spin out and form their own firm. In September 2018, Mary announced she was leaving Kleiner Perkins to start Bond Capital. 3 other partners came with her: Mood Rogani, Noah North, and Juliet de Bourbonnais. Together they would continue the growth investing strategy they had built at Kleiner. The split was described as amicable. Kleiner said the environment for venture capital had evolved. Larger checks were being written at earlier stages. More support from partners was required to build companies. This demanded specialization and focus. Having separate firms for early stage and growth stage made sense. Mary would continue to manage Kleiner's existing growth funds while building Bond. Starting Bond Capital was a bold move. Mary was nearly 60 years old. She had the option to coast, to stay at Kleiner, to gradually wind down her career. Instead, she was building something new. She was betting on herself. She was raising a massive fund from scratch. And she was making history. Bond would be the first venture capital fund founded and led by a woman to raise over $1 billion. By April 2019, Bond had closed its first fund with $1.25 billion in capital commitments. This was an enormous amount of money. It showed the confidence that limited partners had in Mary's track record and judgment. Pension funds, endowments, family offices, sovereign wealth funds. They were all betting Mary would continue finding and backing the companies that would define the next decade of technology. In May 2019, Bond announced its first investment. Canva, an online design platform based in Australia, raised $70 million. Bond co-led the round, which valued Canva at $2.5 billion. Mary saw in Canva what she had seen in so many other successful companies. Passionate founders who cared deeply about the product. A platform that empowered users to do something they couldn't do before. Rapid user growth. Strong network effects as more people used it and shared their designs. Canva would become one of Bond's best investments. By 2021, the company was valued at $40 billion. The investment Mary led had multiplied 16 times in just 2 years. This was the pattern repeating. Find exceptional founders building products people love. Invest when there's already strong evidence of product-market fit but before the company has reached its full potential. Support the founders as they scale. Watch the value compound. Bond continued investing. They backed Plaid, the financial technology company that connects applications to users' bank accounts. Plaid would be valued at $13.5 billion. They invested in Checker, a background check platform used by companies like Uber and DoorDash. They put money into On Running, a premium running shoe company that went public in 2021. They backed Clear, the biometric identity company used at airports and stadiums. In March 2021, Bond closed its second fund with $2 billion in capital commitments. In just 18 months, Mary had raised over $3 billion across 2 funds. This was validation of everything she had built. Her track record from Kleiner Perkins was carrying over to Bond. Her portfolio companies were becoming more valuable. Her reputation as one of the best growth investors in the world was intact. What made Mary Meeker so successful? Why did she consistently identify winners when so many other investors missed them? Part of it was her deep research. Mary had spent decades studying technology trends, reading hundreds of research reports, talking to thousands of executives, analyzing countless data points. She had built mental models for how technology adoption works, how network effects create defensible businesses, how consumer behavior changes over time. Part of it was her focus on founders. Mary looked for what she called unbelievable product passion. She wanted founders who were obsessed with their product, who spent every waking hour thinking about how to make it better, who couldn't imagine doing anything else. She cited Daniel Ek at Spotify as a perfect example. Ek wasn't trying to build a music streaming company as a way to get rich. He was trying to solve a problem he cared deeply about. How do artists get paid fairly while giving fans access to all the world's music? Part of it was her framework for understanding what creates value. Mary looked for companies operating at the intersection of content, community, and commerce. Companies that had all 3 elements were building something powerful. Canva had content in the form of design templates. It had community through sharing and collaboration features. It had commerce through premium subscriptions. This combination created network effects and sustainable competitive advantages. Part of it was timing. Mary had learned from the dot-com crash that being too early is the same as being wrong. You can have the right thesis about where technology is going, but if you invest before consumers are ready or before the infrastructure exists to support the business model, you'll lose money. Mary waited for evidence. She wanted to see real user growth, real revenue, real proof that the idea worked. Then she invested aggressively. Part of it was her network. After 40 years in technology, Mary knew everyone. When a promising company was raising money, Mary would hear about it. When entrepreneurs needed advice, they called her. When companies needed help with strategy, product, hiring, or preparing for an IPO, Mary had the relationships to help. This network was self-reinforcing. Her successful investments gave her credibility, which gave her access to the next generation of promising companies. But perhaps most important was Mary's genuine love for technology and its potential to improve people's lives. She wasn't investing just to make money. She believed deeply that technology companies could solve real problems. They could make education more accessible. They could make financial services more inclusive. They could give small businesses tools that previously only big companies could afford. They could connect people across distances. They could unleash human creativity. Mary's career also represented something larger. She was one of the most prominent women in venture capital at a time when the industry was overwhelmingly male. The statistics were stark. Less than 10% of venture capital partners were women. Less than 3% of venture capital dollars went to female-founded companies. Women faced structural barriers in getting funding, getting taken seriously, getting invited into the networks where deals happened. Mary had broken through. She had proven that a woman could be just as good at spotting technology trends, just as good at evaluating founders, just as good at building portfolio companies as any man. Her success opened doors for other women. It showed limited partners they should be funding more female venture capitalists. It showed entrepreneurs that women could be powerful advocates and helpful board members. As Mary continued working in 2025, she was increasingly focused on artificial intelligence. She saw AI as potentially as transformative as the internet had been 30 years earlier. But she also recognized the AI investment landscape was complex and evolving rapidly. Unlike the internet, where infrastructure costs were relatively low and startups could build applications with modest capital, AI required enormous resources for training models and serving predictions at scale. In May 2025, Bond published its first trends report on artificial intelligence. After pausing her annual Internet Trends reports in 2019 to focus on building Bond, Mary was back to long-form data-driven analysis. The AI Trends report was vintage Mary Meeker. Hundreds of slides. Comprehensive data on AI adoption across industries. Analysis of where the technology was heading. Predictions about which applications would gain traction first. The report highlighted several themes. AI was following the same adoption curve as previous transformative technologies. It would be overhyped in the short term but underestimated in the long term. The companies that would win weren't necessarily the ones building the core AI models. They would be the ones finding specific use cases where AI created enormous value for users. They would be the ones figuring out the business models that made AI sustainable. Mary noted AI was different from previous technology waves in important ways. It was advancing faster. The time from research breakthrough to commercial application was measured in months rather than years. It was more general purpose. Previous technologies were good at specific tasks. AI could be applied to almost any problem that involved processing information or making decisions. And it was more democratized. Small companies and even individuals could build on top of large language models and create applications that would have required massive resources just a few years earlier. But Mary also warned about challenges. AI raised questions about privacy, about bias, about job displacement, about concentration of power. The companies that controlled the best AI models would have enormous advantages. Regulators would eventually step in, but it wasn't yet clear what rules would look like. Society would have to grapple with fundamental questions about how much decision-making we wanted to delegate to machines. Looking back on Mary's career, several patterns emerge. She has consistently been early to major technology shifts, but not too early. She saw the internet revolution coming before most Wall Street analysts. She understood the importance of mobile before desktop internet users peaked. She recognized that on-demand services would become huge before Uber dominated transportation. She's now studying AI intensely, trying to understand which applications will matter most. She has maintained a rigorous analytical approach while also trusting her instincts. Mary is famous for her data-driven presentations. She'll show you charts and graphs proving every point. But she also talks about the importance of founder passion, of product quality, of things that can't be easily quantified. The best investors combine analysis with judgment. They use data to inform their decisions but recognize that transformative companies often break the patterns. She has adapted to multiple roles and multiple eras. Wall Street analyst during the dot-com boom. Analyst again during the recovery. Venture capitalist at Kleiner Perkins. Founder of her own firm at Bond. Each transition required learning new skills, building new relationships, proving herself all over again. Many people succeed in one role and stay there. Mary kept reinventing herself. She has maintained her reputation through both successes and failures. The dot-com crash could have ended her career. Many of her peers never recovered. But Mary acknowledged her mistakes, learned from them, and kept working. When she made good investments, she was appropriately modest. When she made mistakes, she owned them. This intellectual honesty built trust. Mary Meeker is now in the final phase of her career. She has built Bond into a successful firm with over $3 billion under management. Her portfolio includes some of the most valuable private companies in the world. She has trained a new generation of investors who work with her at Bond. She has established frameworks and processes that will outlive her tenure. What drives her now? She still has the same competitive fire her father instilled in her in Portland, Indiana. She still wants to find the next great company before anyone else sees its potential. She still believes in technology's power to solve problems and improve lives. She still gets excited when she meets a founder who has that unbelievable product passion. The story of Mary Meeker is the story of American technology over the past 4 decades. From personal computers to the internet to mobile to on-demand services to artificial intelligence. She has been there for every wave. She has helped fund and build the companies that drove each transformation. She has influenced how millions of people think about technology and investing. She is the queen of the internet, a title she earned through decades of rigorous research, bold bets and unwavering conviction. She has shown that one person from a small town in Indiana can shape the future of technology. That success comes from preparation meeting opportunity. That being first matters, but only if you're also right. That data and intuition together are more powerful than either alone. Mary's legacy will be measured in the companies she backed, the entrepreneurs she supported, the insights she shared, and the doors she opened for others. She has been one of the most influential people in technology for a generation. Her work will shape the industry for decades to come. And she's not done yet. The secret to Mary's sustained success lies not in any single brilliant insight, but in a system she refined over decades. While other investors chased the hottest deals or relied on their gut instincts, Mary built a repeatable process for identifying exceptional companies. This process combined rigorous quantitative analysis with qualitative judgment about founders and markets. It allowed her to be consistently right more often than she was wrong, which in venture capital is all that matters. At the core of Mary's approach was data. She believed that numbers told stories if you knew how to read them. She would dive deep into metrics that most investors overlooked. User engagement rates, retention curves, cohort analysis showing how customer behavior changed over time, revenue per user, customer acquisition costs versus lifetime value, network effects and virality coefficients. These weren't just abstract concepts. They were the fundamental building blocks of technology businesses. But Mary understood that data alone wasn't enough. The best investors knew how to combine quantitative analysis with qualitative assessment. They could look at the numbers and understand what they meant about the product, the team, the market opportunity. They could see when metrics that looked mediocre on the surface actually indicated something promising underneath. They could identify when impressive top-line growth masked underlying problems. Mary's other advantage was pattern recognition built over 4 decades. She had seen hundreds of technology companies grow from small startups to global giants. She had watched countless others fail. She knew what success looked like at different stages. She could identify the early signals that a company was onto something real. Strong user growth that was organic rather than paid. High retention rates indicating genuine product-market fit. Users who loved the product so much they told their friends about it. She also recognized the patterns that predicted failure. Companies that grew through expensive marketing rather than word of mouth. Founders who were better at selling the vision than executing the details. Products that got users to try them once but couldn't keep them coming back. Business models that depended on assumptions that seemed questionable. Markets that looked large but where willingness to pay was actually limited. Mary's investment philosophy emphasized several key principles. First, invest in large and growing markets. She had learned from her time on Wall Street that companies in expanding markets could succeed even with mediocre execution, while companies in shrinking markets struggled no matter how well they performed. The internet was a massive growing market in the 1990s. Mobile was a huge growing market in the 2000s. On-demand services grew rapidly in the 2010s. AI represents another enormous market today. Second, back founders with product passion and missionary zeal. Mary looked for entrepreneurs who were building something they personally cared about deeply, not just pursuing a business opportunity. She wanted founders who had experienced the problem themselves and were obsessed with solving it. She cited examples like Stuart Butterfield at Slack, who had been frustrated by poor team communication tools. Or Melanie Perkins at Canva, who had struggled with complex design software and wanted something anyone could use. These missionary founders had several advantages. They understood their customers because they were their customers. They had the persistence to keep going when things got hard, which they always did. They attracted talented people who shared their vision. They made better product decisions because they cared about quality, not just growth. And they were more trustworthy because they weren't just trying to flip the company for a quick exit. Third, look for products that users love, not just like. Mary wanted to see genuine enthusiasm. She looked at Net Promoter Scores, which measured how likely customers were to recommend a product. She read user reviews and social media comments. She talked to actual users to understand what they valued. She wanted products that created wow moments, that delighted users, that became essential parts of people's lives. Products that users loved had powerful advantages. They grew organically through word of mouth, reducing customer acquisition costs. They had high retention rates, increasing lifetime value. They could charge premium prices because customers valued them highly. They built strong brand loyalty that protected against competition. And they attracted talent because people wanted to work on products that mattered. Fourth, invest when there's evidence but before it's obvious to everyone. Mary had learned from the dot-com crash that being too early was just as bad as being wrong. But she also knew that waiting until success was guaranteed meant paying too high a price. The sweet spot was investing when a company had proven its model with early customers but before it had achieved mainstream adoption. This required judgment about tipping points, about when something would cross from niche to mass market. Fifth, think long-term. Mary's investments typically had 5 to 10-year time horizons. She wasn't trying to flip companies quickly. She was looking for businesses that could compound value over many years. This long-term orientation gave her patience that other investors lacked. She could support companies through difficult periods. She could encourage them to make investments in product and infrastructure that would pay off later rather than chasing short-term metrics. Mary also developed strong views on what created defensible competitive advantages in technology businesses. Network effects were the most powerful. Products where value increased as more people used them were extraordinarily difficult to displace. Facebook benefited from network effects because people joined to connect with friends who were already there. Airbnb benefited because more hosts attracted more guests, which attracted more hosts. Spotify benefited because more users generated better data for recommendations. Economies of scale mattered too. Companies that could spread fixed costs over larger revenue bases had structural advantages. Amazon's logistics infrastructure got more efficient as volume increased. Google's search algorithms improved as they processed more queries. These advantages compounded over time, making it harder for smaller competitors to catch up. Switching costs provided another source of defensibility. Products that became embedded in workflows or stored valuable user data were hard to replace. DocuSign benefited because switching document management systems was painful. Slack benefited because teams built extensive message histories and integrations they didn't want to lose. The higher the switching costs, the more pricing power a company had. Brand value created defensibility in consumer markets. Strong brands reduced customer acquisition costs, enabled premium pricing, and provided protection during crises. Apple's brand allowed it to charge more than competitors. Nike's brand gave it pricing power in athletic footwear. Building a truly strong brand required years of consistent execution and customer delight, but once established it was very difficult to destroy. Mary was also thoughtful about what she brought to portfolio companies beyond capital. She recognized that at the growth stage, companies didn't just need money. They needed strategic advice from someone who had seen many companies navigate similar challenges. They needed help recruiting executives, especially CFOs and other leaders who could prepare the company for being public. They needed connections to potential partners, customers, and other investors. Mary's value add came from several sources. Her decades of experience gave her perspective on what worked and what didn't. She had seen companies make mistakes and could help others avoid them. She had watched successful companies navigate key decisions and could share those playbooks. She knew which battles were worth fighting and which weren't. Her network was extraordinary. After 40 years in technology, Mary knew thousands of people across the industry. She could make introductions that opened doors. When a portfolio company needed to hire a CFO, Mary knew the best candidates. When they needed to find enterprise customers, she could connect them to decision makers. When they were considering strategic acquisitions, she could facilitate conversations with potential targets. Her brand added credibility. When Mary Meeker invested in a company, it signaled quality to other investors, potential employees, customers, and partners. It made subsequent fundraising easier. It helped attract talent. It gave enterprise customers confidence that this startup would still be around in 5 years. This reputational capital was something Mary had built over decades, and it benefited every company she backed. Mary also provided emotional support during difficult times. Building a company was incredibly hard. There were always moments of doubt, crisis, and despair. Having an investor who had seen it all before and could provide encouragement was valuable. Mary had credibility to tell founders that the problem they were facing wasn't unique, that other companies had overcome similar challenges, that they should keep going. But Mary was also willing to deliver hard truths when necessary. She would tell founders when their strategy wasn't working, when they needed to make leadership changes, when they were burning cash too quickly. These conversations were difficult but essential. The best board members weren't cheerleaders. They were truth-tellers who combined supportiveness with honesty. Mary's approach to board service reflected her overall philosophy. She prepared extensively for every board meeting. She would review all the materials in advance, come with questions prepared, and dive deep into the metrics. She focused on the biggest strategic questions rather than getting lost in operational details. She helped management teams think through multi-year scenarios and prepare for different outcomes. She was particularly effective at helping companies prepare for going public. This was a natural extension of her Wall Street background. She understood what public market investors cared about, how they evaluated companies, what they wanted to hear in earnings calls. She could help management teams develop their equity story, identify the right investment banks, navigate the S-1 process, and prepare for life as a public company. The IPO process had changed dramatically since Mary's early days at Morgan Stanley. In the 1990s and early 2000s, most technology companies went public relatively early. They might have 50 million in revenue and be growing rapidly. Going public provided capital to fuel growth and gave employees and early investors liquidity. But the process was expensive and time-consuming. And being public meant quarterly earnings pressure and extensive disclosure requirements. By the 2010s, companies were staying private much longer. Abundant private capital from growth investors like Mary meant companies could raise hundreds of millions or even billions of dollars without going public. They could reach much larger scale before facing public market scrutiny. By the time they IPO'd, they might have billions in revenue and be profitable or close to it. This shift created opportunities for growth investors. They could invest in companies that were already large and successful but still had enormous upside before going public. They could earn returns that previously only public market investors captured. And they could have more influence than they would have as small shareholders in public companies. But the shift also created challenges. Private market valuation sometimes got disconnected from what public markets would support. Companies that raised money at high valuations in the private market sometimes struggled when they went public. Employees who joined late and got stock options at peak private valuations saw their equity underwater if the IPO price was lower. And the lack of public market discipline meant some companies developed bad habits around profitability and capital efficiency. Mary was thoughtful about valuation discipline. She was willing to pay premium prices for exceptional companies, but she also passed on deals where the valuation seemed disconnected from fundamentals. She had seen too many companies raise money at unsustainable valuations that created problems later. She preferred to invest at reasonable prices in great companies rather than pay any price to get into a hot deal. This discipline sometimes meant missing out on investments. Other investors would pay higher prices and Mary would pass. Sometimes those companies succeeded anyway and she would have made money even at the higher price. But she believed that over many investments, valuation discipline improved overall returns. Paying reasonable prices created margin of safety. It meant you could still make money even if the company's growth slowed or markets repriced. Mary's investment track record at Bond demonstrated her approach in action. Look at Canva. When Bond invested in 2019, Canva already had clear product market fit. Millions of people were using it to create designs. Revenue was growing rapidly. The viral coefficient was strong, meaning existing users were bringing in new users organically. The retention rates showed people kept coming back. The Net Promoter Score was exceptionally high. But the opportunity was still enormous. Most people who needed to create designs occasionally weren't yet using Canva. The product was adding new features and use cases. International expansion was still early. Monetization had room to improve. And the shift to remote work during COVID would dramatically increase demand for online design tools. All of these factors meant the company could grow much larger. Mary's investment in Plaid followed similar logic. Plaid had built essential infrastructure for fintech applications. Any app that needed to connect to users' bank accounts used Plaid. That meant they had extremely high retention because switching would require rebuilding integrations. The market was growing as more fintech applications launched. And Plaid had opportunities to expand beyond simple account connectivity into additional financial data services. When Visa tried to acquire Plaid for $5.3 billion in 2020, it validated Mary's thesis. Visa saw Plaid as strategic infrastructure they needed to own. The deal ultimately fell apart due to regulatory challenges, but it showed how valuable the company had become. Plaid continued growing independently and raising money at higher valuations. Mary's investment in OnRunning showed her ability to identify opportunities beyond pure software. On was a premium running shoe company founded in Switzerland. They had developed innovative cushioning technology that reduced impact on joints. The product was genuinely differentiated. Serious runners loved the shoes and became brand evangelists. The company had a clear path to expanding beyond running into other athletic categories. On went public in September 2021 at $15 per share, valuing the company at about $7 billion. The stock initially performed well before pulling back along with the broader market in 2022. But the company continued growing revenue and expanding margins, demonstrating the strength of the underlying business. This investment showed Mary's willingness to back companies across different sectors if the fundamentals were strong. Looking at Mary's career comprehensively, several meta patterns emerged. First, she had consistently adapted to changing circumstances. She didn't stick with one approach regardless of context. She evolved from Wall Street analyst to venture capitalist to founder of her own firm. She shifted her focus from internet businesses to mobile to on-demand services to AI. She changed how she evaluated companies as markets and business models evolved. This adaptability was crucial to sustain success over decades. Second, she maintained consistent principles while changing tactics. Her core framework, investing in exceptional founders building products that users loved in large growing markets, remained constant. But how she applied that framework evolved. The metrics she tracked changed as business models shifted from desktop to mobile to on-demand. The stage at which she invested moved from public markets to private late stage. The specific sectors she focused on evolved with technology waves. Principles persisted even as implementation changed. Third, she built compounding advantages over time. Each success made the next one easier. Her early wins gave her capital and credibility. That let her access better deals. Better deals generated better returns. Better returns attracted more capital and better entrepreneurs. This flywheel accelerated over decades. By the time she started Bond, she had such a strong reputation that raising over $1 billion was possible despite starting a new firm in her late 50s. Fourth, she stayed focused on what she was exceptionally good at rather than trying to do everything. Mary didn't try to be an early-stage seed investor. She didn't try to do buyouts or turnarounds. She focused on growth-stage investing in technology companies where her deep sector knowledge and analytical capabilities created genuine advantages. This focus let her be truly excellent rather than mediocre at many things. Fifth, she continuously learned and incorporated new information. Mary wasn't dogmatic. When she made mistakes, she studied them and adjusted her approach. When markets changed, she updated her frameworks. When new types of companies emerged, she developed new ways of evaluating them. This learning orientation kept her relevant across multiple technology generations. These patterns offered lessons for anyone trying to build a successful career, not just in investing but in any field. Adapt tactics while maintaining core principles. Build compounding advantages over time. Focus on your strengths rather than spreading too thin. Never stop learning and updating your beliefs. These were simple ideas but extremely difficult to execute consistently for decades. Mary's investment philosophy had broader applicability too. The idea of looking for people with genuine passion rather than those just pursuing opportunities applied to hiring, to partnerships, to any relationship. The principle of finding large growing markets where success was easier made sense for career choices and business decisions. The discipline of requiring evidence before committing resources was wise in many contexts. The patience to think in years rather than months created advantages wherever compounding was possible. As Mary continued working in 2025, she was thinking about these lessons and how to transmit them. She gave occasional talks at business schools and conferences. She mentored younger investors, especially women trying to break into venture capital. She participated in industry initiatives trying to increase diversity and inclusion. She wasn't as public-facing as some investors, but she used her platform to share what she had learned. She also continued doing what she did best, which was finding great companies. Bond's portfolio kept expanding. They invested in companies working on climate technology, on biotechnology, on financial infrastructure, on AI applications. Mary applied her frameworks to each opportunity. Large growing market? Exceptional founders? Product that users loved? Evidence of traction? Reasonable valuation? If the answers were yes, she invested. If not, she passed. The venture capital industry Mary operated in had changed dramatically from when she started. In the 1990s, there were perhaps a few hundred venture capitalists managing maybe $50 billion. By the 2020s, there were thousands of VCs managing over $1 trillion. Capital was abundant. Competition for deals was fierce. Valuations were high. The edge that investors like Mary once had from superior information or analytical capabilities had narrowed as more smart people entered the field. This meant Mary had to work even harder to maintain her advantage. She couldn't rely on being the only person who understood internet businesses or had access to promising startups. Every deal now had multiple investors competing for allocation. Founders had abundant choices about who to partner with. Capital itself was no longer scarce. So investors had to differentiate on other dimensions like strategic value, network access, brand reputation, and board effectiveness. Mary's track record and reputation gave her access. Founders wanted Mary Meeker on their board. Her name added credibility. Her insights on trends and strategy were valuable. Her network could open doors. Her experience helping companies prepare for going public was relevant. These advantages were hard for newer investors to replicate quickly. They took decades to build. But Mary also knew that advantages could erode. Younger investors were building their own track records. New firms were developing their own brands. The industry kept evolving, and what worked yesterday might not work tomorrow. She couldn't rest on past success. She had to keep earning her position through current performance. This created intensity that defined Mary's approach. She was never satisfied. She always pushed for more data, more insights, deeper understanding. She interrogated her own assumptions. She looked for disconfirming evidence. She studied her mistakes obsessively. She tried to stay humble even as her success grew. This mindset of continuous improvement was part of what kept her successful when others who had similar early success faded. Mary was also thinking about her impact beyond just financial returns. Yes, she had generated billions of dollars for limited partners. But what else had she created? The companies she backed employed hundreds of thousands of people. They provided services that millions or billions of consumers used. They pioneered business models that others built on. They advanced technologies that enabled further innovation. Canva had democratized design, allowing people without formal training to create professional-looking graphics. Spotify had transformed how people discovered and consumed music while creating new revenue streams for artists. Square had enabled small businesses to accept card payments affordably. Airbnb had given property owners new income sources while giving travelers more options. These impacts extended far beyond just shareholder returns. But Mary also knew her portfolio companies had created challenges. They had disrupted existing businesses and displaced workers. They had raised regulatory questions about labor classification, data privacy, market power, and more. They had contributed to winner-take-all dynamics where a few companies dominated their markets. They had sometimes prioritized growth over profitability in ways that created unsustainable expectations. These complexities were part of the reality of transformative innovation. Mary believed the net impact was positive. The companies she backed had created more value than they destroyed. They had made people's lives better in tangible ways. They had increased productivity and efficiency. They had given consumers more choices and lower prices. They had enabled new forms of creativity and connection. But she also acknowledged that innovation created losers as well as winners, and that society needed to help those who were negatively affected by change. These questions about technology's broader impact would only intensify with artificial intelligence. AI had potential to be even more transformative than the internet. It could revolutionize healthcare by improving diagnosis and drug discovery. It could personalize education to each student's needs. It could accelerate scientific research across every field. It could automate tedious work and free humans to focus on more creative and meaningful tasks. But AI also raised profound concerns. It could displace millions of workers whose jobs involved routine cognitive tasks. It could amplify biases present in training data. It could be used for surveillance and control. It could concentrate power in companies and countries that controlled the best AI systems. It could make decisions that affected people's lives in ways that were opaque and unaccountable. It could even pose existential risks if developed without adequate safety measures. Mary was optimistic that these challenges could be addressed through thoughtful development and appropriate governance. She believed that AI systems could be designed to be more transparent and fair. She thought that education and retraining could help workers adapt to changing job markets. She expected that regulation would evolve to address the most serious risks while still allowing beneficial innovation. She hoped that the benefits would be distributed broadly rather than accruing only to a few. But she also knew that outcomes weren't predetermined. They would depend on choices that developers, investors, policymakers, and society made. The venture capitalists who funded AI companies would influence how those companies approached safety, fairness, and transparency. If investors only cared about financial returns and ignored broader impacts, companies would optimize accordingly. If investors demanded responsible development, companies would respond to those incentives. Mary was trying to use her influence to encourage responsible AI development. In meetings with portfolio companies working on AI, she asked about their approaches to bias and fairness. She encouraged them to invest in safety research. She connected them with experts who could help them navigate ethical challenges. She recognized that these conversations were uncomfortable and sometimes slowed development, but she believed they were necessary. This represented some evolution from how venture capital had traditionally operated. The old model was simple. Invest in companies with the highest potential returns. Help them grow as fast as possible. Exit at maximum valuation. Don't worry too much about broader impacts because innovation was assumed to be good and markets would sort out what was valuable. The new model was more complex. Still invest in companies with high return potential, but also consider how they would affect stakeholders beyond shareholders. Still help them grow, but encourage sustainable rather than reckless growth. Still seek strong returns, but not at any cost. Think about long-term reputation and systemic effects, not just individual deals. Mary was navigating this transition along with the rest of the industry. She didn't have all the answers. She was trying to balance her belief in the power of innovation with recognition that technology could cause harm. She was attempting to maintain financial performance while also caring about broader impacts. It was challenging and there weren't clear roadmaps. One thing Mary felt strongly about was the importance of diversity in the technology industry. She had seen throughout her career how homogeneous teams made worse decisions. When everyone came from similar backgrounds and had similar perspectives, they missed opportunities and created products that didn't work for all users. Diverse teams brought different viewpoints that led to better products and more innovative solutions. Mary tried to encourage portfolio companies to prioritize diversity in hiring and leadership. She asked about their efforts to recruit women and underrepresented minorities. She connected them with diverse candidates for key roles. She highlighted research showing that diverse teams performed better financially. She used her board seat to advocate for inclusion. But she also recognized that venture capital itself had serious diversity problems that limited how much impact she could have. Women were still drastically underrepresented among venture capital partners. People of color even more so. This meant that the investors making funding decisions were overwhelmingly white men, which affected which companies got funded and which founders got opportunities. Female founders received only about 2% of venture capital dollars despite starting companies at nearly the same rate as men. This wasn't because their companies were lower quality or less successful. Studies showed that female-founded companies actually generated higher returns on average. The disparity reflected biases in how investors evaluated founders and opportunities. Mary had broken through these barriers herself, but that didn't mean they no longer existed. If anything, her exceptional success might make the barriers less visible. People could point to her and argue that gender didn't matter because look, Mary Meeker succeeded. But this ignored how unusual her path was and how many talented women never got similar opportunities. Mary tried to use her success to create opportunities for other women. She mentored female investors and entrepreneurs. She introduced them to her network. She advocated for funding female-founded companies. She supported organizations working to increase diversity in venture capital. She spoke publicly about the importance of giving opportunities to people from all backgrounds. But she also acknowledged that individual actions weren't enough to create systemic change. The industry needed structural reforms. Venture capital firms needed to deliberately hire more diverse partners. They needed to examine their investment processes for bias. They needed to expand their networks beyond the traditional pipeline. They needed to hold themselves accountable for improving diversity metrics. Some progress was happening. More women were becoming venture capital partners. More funds were being raised by diverse managers. More attention was being paid to funding female founders and founders from underrepresented groups. But the pace of change was slow and the baseline was so low that even significant percentage improvements still left the industry overwhelmingly homogeneous. Mary would be part of the generation that started addressing these issues but wouldn't live to see full equality achieved. That work would fall to younger investors who were more diverse themselves and who were building firms with inclusion as a core value from the beginning. Mary could help by providing capital to diverse fund managers, by sharing her platform with underrepresented voices, and by continuing to demonstrate through her success that diversity improved outcomes. As Mary reflected on her career in 2025, she felt pride in what she had accomplished but also awareness of work left undone. She had helped build some of the most important technology companies of her generation. She had influenced how millions of people thought about technology trends and investment opportunities. She had demonstrated that women could succeed at the highest levels of a male-dominated industry. But she hadn't solved the industry's diversity problems. She hadn't prevented technology companies from causing harm even as they created value. She hadn't figured out how to ensure that the benefits of innovation were distributed equitably. These challenges would persist long after her career ended. They required sustained effort from many people across multiple generations. Mary's personal life outside work remained limited. She still lived in the Bay Area. She maintained a small circle of close friends. She played golf occasionally. She read voraciously about technology, business, and history. But work remained the center of her life. She checked email constantly. She took calls from founders at all hours. She traveled frequently to visit portfolio companies. She was always thinking about markets, companies, and investments. Some people who knew her worried that she worked too hard, that she needed to slow down, that at 65 she should be thinking about retirement or at least reducing her schedule. But Mary showed no interest in stopping. She loved what she did. She found meaning and fulfillment in identifying great companies and helping them succeed. Why would she stop doing something she loved and was still good at? She had also watched other investors retire and seen how difficult the transition could be. People whose entire identity was wrapped up in their work struggled when that work ended. They lost their sense of purpose. They felt irrelevant. They didn't know how to fill their days. Mary wasn't ready for that. She would keep working as long as she was effective and engaged. She was also motivated by the opportunity ahead with artificial intelligence. AI felt to Mary like the internet had felt in the 1990s. It was a fundamental technology that would transform everything. The companies built during this transition would shape the economy for decades. Being part of identifying and supporting those companies was exciting. She didn't want to miss this wave. Bond's third fund was in the works. Mary was in discussions with limited partners about raising additional capital. The firm had delivered strong returns on its first two funds. Portfolio companies were growing and increasing in value. Several were preparing for IPOs or strategic acquisitions. The track record was strong enough to support raising an even larger fund if they chose to. Mary was thinking carefully about the right size. Bigger funds generated more fee revenue and allowed larger investments in each company. But they also required deploying more capital, which could lead to investing in lower quality opportunities just to put money to work. They could change the firm's dynamics and culture. They could make it harder to generate the same percentage returns even if absolute returns increased. Mary wanted Bond to remain focused and disciplined. She would rather raise less capital and invest only in the very best companies than raise too much and lower her standards. This discipline had served her well throughout her career. She passed on many more deals than she did. She was comfortable saying no. She knew that great investments were rare and worth waiting for. The venture capital industry had seen many firms lose their way by getting too big. They raised massive funds because they could, then struggled to deploy the capital effectively. Their returns declined. Their reputation suffered. They became more like asset managers than true investors. Mary wanted to avoid this trap. She was also thinking about Bond's culture and values. What kind of firm did she want to build? How did she want people to work together? What behaviors should be rewarded? What principles should guide decision-making? These questions mattered because culture shaped outcomes over time. A strong culture would help Bond succeed after Mary stepped back from day-to-day involvement. Mary believed in rigorous analysis combined with respect for different viewpoints. She wanted debate and disagreement during decision-making, but alignment once decisions were made. She valued hard work and preparation but also recognized that people needed lives outside the office. She expected honesty about mistakes and continuous learning. She wanted the firm to be a place where talented people could do their best work. Building this culture required intentionality. It meant hiring people who shared these values. It meant modeling the behaviors she wanted to see. It meant having difficult conversations when people fell short. It meant creating systems and processes that reinforced the culture. It was ongoing work that was never truly finished. Mary was also focused on knowledge transfer. How could she help her partners learn what she knew? How could she codify the frameworks and instincts that guided her investment decisions? How could she ensure that Bond's investment approach would persist even without her direct involvement in every decision? She was creating more documentation of her process. Writing memos about how she evaluated companies. Recording presentations explaining her frameworks. Conducting postmortems on investments to capture lessons learned. Making her thinking more transparent so others could learn from it. This was harder than it sounded because much of her expertise was tacit knowledge that was difficult to articulate. She was also giving her partners more autonomy to lead deals while remaining available to advise. They needed to make their own decisions and sometimes their own mistakes. She couldn't protect them from every error. They had to build their own judgment through experience. Her role was to provide coaching and feedback to help them learn faster. Mary was confident in her partners. They were smart, hard-working, and passionate about technology. They had learned from working with her at Kleiner, Perkins, and now at Bond. They had developed their own networks and sourcing capabilities. They had their own relationships with founders. They were ready to take on more responsibility as Bond evolved. The question was whether they could maintain the firm's performance as Mary's direct involvement decreased over time. The broader venture capital ecosystem was also evolving in ways that created both opportunities and challenges. New types of investors were entering the market. Hedge funds were doing more late-stage private investing. Mutual funds were buying into private companies before they went public. Sovereign wealth funds were making direct investments rather than just allocating to venture capital funds. Corporate venture arms were proliferating as companies wanted strategic exposure to emerging technologies. This influx of capital had pushed valuations higher and made competition for the best deals more intense. Companies could now raise enormous amounts of money at each stage. Series A rounds that used to be $5 to $10 million were now $50 to $100 million. Series B rounds were hundreds of millions. Late-stage rounds were sometimes over $1 billion. This mega-round environment created new dynamics. For investors like Mary, these large rounds meant they could deploy more capital per investment, which helped when managing multi-billion-dollar funds. But it also meant that mistakes were more expensive. If a company raised money at a $10 billion valuation and the business didn't grow into that valuation, everyone who invested at that price would lose money. The margin for error had narrowed. Mary tried to maintain valuation discipline even in this frothy environment. She would still pass on companies whose valuations seemed disconnected from fundamentals. She would still insist on understanding the path to profitability and sustainable unit economics. She would still model different scenarios and stress test assumptions. This sometimes meant missing hot deals, but it protected Bond's portfolio from the worst excesses. The environment reminded Mary somewhat of the late 1990s dot-com boom. Abundant capital, aggressive valuations, competition for deals, fear of missing out. She had lived through what happened when that bubble burst. She remembered how many companies failed and how much wealth evaporated. She was determined not to repeat those mistakes. But this cycle also had important differences. The companies receiving funding now were generally more mature and had proven business models. They had real revenue and often real profits. They weren't just concepts or stories. The technology infrastructure was more developed. Cloud computing made it cheap to build and scale products. Mobile devices gave companies access to billions of potential customers. The underlying fundamentals were stronger. Still, Mary knew that cycles eventually turned. Valuations that seemed reasonable during boom times looked absurd when markets corrected. Companies that could easily raise capital suddenly struggled. Investors who had been aggressive became conservative. The music stopped and some companies found themselves without chairs when the market repriced. Mary had structured Bond's portfolio with this in mind. She had insisted that portfolio companies maintain substantial cash reserves. She had encouraged them to extend their runways and not spend too aggressively. She had helped them develop contingency plans for different market scenarios. She wanted them to be able to survive a downturn without having to raise capital at distressed valuations. This advice became prescient in 2022 when public market valuations for technology companies declined sharply. Interest rates rose as central banks fought inflation. Investors became more focused on profitability and less willing to fund unprofitable growth. Many companies saw their valuations cut in half or more. Some that had raised money at peak valuations struggled to raise their next rounds. Bond's portfolio was affected like everyone else's. Paper valuations declined. Some companies had to cut staff and reduce spending. But because Mary had encouraged financial discipline, most of her portfolio companies weathered the storm. They had enough capital to get through difficult periods. They had paths to profitability that didn't require raising more money at bad prices. They could focus on building sustainable businesses rather than just chasing growth. This validated Mary's long-term approach. Yes, she had missed out on some short-term gains by not investing at the peak. But she had also avoided catastrophic losses. Over full market cycles, this discipline generated superior returns. It was another lesson from her decades of experience that newer investors were learning through painful experience. As markets stabilized in 2023 and 2024, Mary was back to actively deploying capital. The market correction had created opportunities. Some excellent companies were available at much more reasonable valuations. Investors who had capital and conviction during downturns could generate outstanding returns. Mary had seen this pattern many times before. She invested in several companies during this period that she expected would become significant winners. Companies that had weathered the storm and emerged stronger. Companies that had used the downturn to build better products and more efficient operations. Companies whose competitors had failed or pulled back, leaving them with less competition and more market opportunity. This counter-cyclical investing was one of Mary's strengths. She didn't panic when markets declined. She didn't get caught up in pessimism and stop investing. She maintained her long-term perspective and looked for opportunities. This required emotional discipline and conviction that conditions would eventually improve. But history showed that the best returns often came from investing during periods of maximum uncertainty and fear. By 2025, markets had recovered substantially. Technology stocks were reaching new highs. AI excitement was driving valuations. Capital was flowing again. The cycle had turned from fear back to optimism. Mary was watching carefully to see if euphoria would return and create another bubble, or if the corrections of 2022 had instilled enough caution to prevent excess. She was also thinking about how technology and society were evolving together. The companies she had backed over the past 15 years had fundamentally changed how people lived. They had transformed commerce, communication, transportation, entertainment, work, and more. But they had also created new tensions and challenges that society was still grappling with. Social media companies had connected billions of people but also enabled misinformation and polarization. E-commerce platforms had made shopping more convenient but disrupted local retail. Ride-sharing services had provided transportation options but raised questions about labor classification. Short-term rental platforms had given travelers choices but affected housing affordability in some cities. These complex trade-offs resisted simple evaluation. Mary believed that technology was neither inherently good nor bad. It was a tool that amplified human intentions and capabilities. The same platform that could spread misinformation could also democratize access to information. The same AI system that could automate jobs could also enhance human productivity. What mattered was how technology was designed, governed, and deployed. This meant that investors, entrepreneurs, policymakers, and citizens all had responsibilities. Investors should fund companies building products that genuinely improved people's lives. Entrepreneurs should design products with user welfare in mind, not just engagement metrics. Policymakers should create rules that encouraged innovation while protecting against harm. Citizens should use technology thoughtfully and hold companies accountable. Mary was trying to play her part by being more thoughtful about what companies she funded and how she advised them. But she also recognized the limits of individual action. Systemic problems required systemic solutions. No single investor or company could solve issues like inequality, misinformation, or climate change. These required collective action across many institutions and stakeholders. As Mary looked toward the future, she saw enormous opportunities in artificial intelligence but also recognized the challenges that needed to be addressed. She saw potential for AI to improve healthcare, education, scientific research, and countless other fields. She also saw risks around bias, privacy, job displacement, and concentration of power. The path forward required balancing innovation with responsibility. She saw opportunities for new technologies to address climate change through better energy systems, more efficient transportation, and innovations in agriculture and manufacturing. She saw companies building climate tech solutions that could be both profitable and impactful. This was an area where market forces and social good aligned, where investors could do well by doing good. She saw potential for technology to make financial services more inclusive and accessible. Companies like Plaid were building infrastructure that let people access banking services regardless of wealth or credit history. Fintech applications were providing alternatives to traditional banks that had underserved low-income communities. This democratization of finance could reduce inequality and expand opportunity. She saw possibilities for technology to improve education by personalizing learning to each student's needs and pace. She saw potential for online platforms to make high-quality education accessible globally rather than just to those who could afford expensive schools. She saw tools that could help teachers be more effective and students learn more efficiently. But she also saw that realizing these positive possibilities wasn't automatic. It required intentional effort to design technology that served broad social interests rather than just maximizing engagement or extracting value. It required business models that aligned company incentives with user welfare. It required governance systems that ensured accountability. Mary was in the later stages of her career, but the work of building beneficial technology would extend far beyond her lifetime. She was trying to set up Bond and her portfolio companies for long-term success. She was sharing lessons from her decades of experience with younger investors and entrepreneurs. She was using her platform to advocate for responsible innovation. She had lived through multiple technology revolutions and had seen how each one transformed society in both positive and negative ways. The personal computer revolution had increased productivity but also created digital divides. The internet revolution had democratized information but also enabled new forms of manipulation. The mobile revolution had made technology ubiquitous but also created issues around attention and addiction. The AI revolution would likely follow a similar pattern. It would create enormous value and solve important problems. It would also create new challenges that society would need to address. The goal was to maximize the benefits while minimizing the harms. This required foresight, planning, and willingness to make short-term sacrifices for long-term good. Mary remained optimistic that humanity would navigate this successfully. She had seen how previous technology challenges had eventually been addressed through some combination of technical solutions, regulatory interventions, social norms, and market forces. She believed the same pattern would hold with AI and future technologies. But she also knew that outcomes weren't predetermined. They depended on choices. And those choices were being made right now by entrepreneurs deciding what to build, investors deciding what to fund, policymakers deciding how to regulate, and citizens deciding what to demand. Every decision mattered. Every action contributed to the future that would unfold. Mary Meeker's story was ultimately about someone who had devoted her life to understanding technological change and supporting innovation. She had started in a small town in Indiana with no obvious path to becoming one of the most influential people in Silicon Valley. She had worked incredibly hard, studied relentlessly, adapted continuously, and maintained rigorous standards across decades. She had succeeded through multiple technology cycles by combining deep analytical capabilities with pattern recognition from experience. She had built a reputation for being early to trends but not too early. She had developed frameworks for evaluating companies that worked across different eras and business models. She had cultivated relationships that gave her access to the best opportunities. She had survived mistakes and setbacks by learning from them rather than being destroyed by them. She had rebuilt her reputation after the dot-com crash when many peers faded away. She had adapted from being a Wall Street analyst to a venture capitalist to founding her own firm. She had remained relevant for decades in a fast-changing industry. She had demonstrated that women could succeed at the highest levels of technology investing. She had broken barriers and opened doors, even though systemic inequality persisted. She had shown that success came from talent and work ethic, not from gender. She had used her platform to mentor and support other women in the industry. She had influenced how an entire generation thought about technology trends and investment opportunities. Her research reports and presentations had shaped countless business strategies and investment decisions. Her frameworks for thinking about network effects, platform businesses, and technology adoption became widely used across the industry. She had backed some of the most important technology companies of the past 2 decades. Her investments had helped these companies grow and scale. Her strategic advice had helped them navigate challenges. Her reputation had given them credibility. Her network had opened doors. She had been part of building businesses that employed hundreds of thousands of people and served billions of customers. She had generated enormous returns for limited partners who entrusted capital to her funds. She had created substantial wealth for herself and her colleagues. She had shown that growth-stage venture capital could be a viable and profitable investment strategy. She had built a firm in Bond that could potentially endure beyond her direct involvement. But Mary's story also highlighted challenges and contradictions in the technology industry. She had succeeded partly by conforming to industry norms that disadvantaged women. She had focused primarily on financial returns rather than broader social impacts. She had backed companies that created both benefits and harms. She had operated within systems that concentrated wealth and power. These complexities didn't diminish Mary's accomplishments, but they provided important context. She was a product of her time and industry. She made choices that made sense given the constraints and incentives she faced. She adapted to the world as it was rather than trying to transform it completely. She focused on what she could control and excelled at it. As Mary continued working in her mid-60s, she carried all of this history and experience. She remained driven by the same competitive fire her father had instilled decades earlier in Portland, Indiana. She still wanted to identify the next great company before everyone else saw its potential. She still believed in technology's power to improve lives. She still found meaning and purpose in her work. The technology industry would continue evolving. New platforms would emerge. New business models would be invented. New challenges would need to be addressed. Mary would be part of that evolution for as long as she remained active. And even after she eventually stepped back, her influence would persist through the companies she backed, the investors she trained, the frameworks she developed, and the lessons she shared. Mary Meeker had become one of the most successful and influential technology investors of her generation through a combination of intelligence, hard work, adaptability, and timing. She had identified and supported companies that transformed industries and changed how billions of people lived. She had influenced how people thought about technology trends and investment opportunities. She had demonstrated that sustained success over decades was possible through rigorous analysis combined with strategic judgment. Her story offered lessons about investing, about technology, and about what it takes to excel in a demanding and rapidly changing field. The Queen of the Internet had earned her crown through 40 years of exceptional work, and her legacy would endure long after her career ended.